Today, we're going to talk about the cost of capital, and we're going to explore a really interesting, kind of provocative idea. What if the one number that greenlights billion-dollar projects, the number that basically justifies a company's very existence, what if it's all just an illusion? It's a paradox, right? A single number that can make or break a company, but it might just be built on a foundation of sand. So let's dig in and see what's really going on here. But before we start pointing out the cracks, let's just appreciate the idea for a second. The cost of capital isn't just some random number on a spreadsheet, it's more of a philosophical concept. Think of it like a high jump bar. A company has to generate returns that clear this bar to create any value at all. If you miss it, you're not just failing, you're actually destroying the wealth of the people who invested in you. So really, it's an economic filter. In a world that's just full of uncertainty where you can't possibly predict the future, the cost of capital is the market's way of asking a really simple question. Is this project a better use of our money than all the other options out there with similar risk? It takes all the market's expectations, all the investor sentiment, and distills it into one potent, unforgiving percentage.
Okay, but this is where the illusion starts to creep in. That single, powerful number. It gives off this vibe of scientific certainty, of precision. The reality, though, is a lot murkier. It's really a carefully constructed illusion of precision.
So the most common way to figure this out is with something called the weighted average cost of capital, or WACC. And a big piece of that is the cost of equity, which usually comes from a model called the Capital Asset Pricing Model, or CAPM. Now, these formulas, they look so clean and objective on a screen, but when you start to peel back the layers, you find they're built on some really shaky, subjective inputs. They're educated guesses at best. Let's just take beta, for example. It's supposed to measure how risky a stock is compared to the overall market. But it's got this fatal flaw. It's always looking backward. It uses what happened in the past to try and predict future risk. Plus, it treats all volatility the same. It doesn't know the difference between a little market wobble and a complete catastrophic crash. And this analogy just sums it up perfectly. Using beta to guide your future investments is literally like trying to drive a car down a winding road at high speed, but you're only allowed to look in the rearview mirror. You're trying to navigate a world that's constantly changing, sometimes violently, using nothing but old information. And the second guess? Well, it's even more of a problem. It's called the market risk premium. It's the extra return that investors expect to get for taking the risk of being in the stock market instead of some risk-free investment. But you see the key word there? Expect. It's an expectation. You can't observe it, you can't measure it, and finance professionals have huge disagreements about how to even estimate it. Should we use 10 years of data, 100 years? This one number can be wildly different depending on who you ask. So what happens when you take these fragile inputs, these guesses, and you use them to make huge, real-world decisions? Well, you get what we can call the great misallocation, a systematic, value-destroying flaw in how companies invest their money. This brings us to the WACC fallacy. It's this incredibly common practice of taking that one company-wide cost of capital we just talked about and using it as the hurdle rate for every single project the company looks at. And this violates the most fundamental rule in finance. The discount rate has to match the risk of the specific cash flows you're looking at. The result is this really perverse internal system. Safe, predictable projects get unfairly penalized. They're judged against this high, company-wide hurdle rate, and a lot of them get rejected. Meanwhile, the risky, speculative projects, they're basically subsidized. They're judged against a rate that's way too low for their actual risk, which makes them look way more attractive than they really are. And what's great about this chart is you can see the damage so clearly. High-risk projects get a rate that's too low, so they look overvalued, and the company overinvests in things that actually destroy value. And the low-risk projects get a rate that's too high. They look undervalued, so the company underinvests in things that could have created real sustainable value. Over time, the company just gets riskier and less profitable. And look, this isn't just some abstract theory. There was research into mergers and acquisitions that found that when this one error is made, when a company uses its own low WACC to value a riskier company it wants to buy, it destroys, on average, 0.8% of its own market value. That is a massive, quantifiable loss from one simple, very widespread mistake. So now we get to the part where this gets really scary. The danger of this flawed number isn't just a straight line, it's exponential. A tiny error in the cost of capital
can have a terrifyingly large impact on how much a company is actually worth.
To get why, you have to understand that for most companies, the majority of their value, we're talking 70% or more, doesn't come from the cash they expect to make in the next 5 years. Nope. It comes from something called terminal value, which is basically a single calculation that represents the value of all of its cash flows from that point on forever. And because this one number is trying to capture value so far out into the future, the math gives the discount rate, or WACC, an insane amount of leverage. A tiny little tweak to that number creates a massive swing in the final valuation. Let me just show you. Okay, so let's start with a base case. We'll use a 10% WACC. That gives us a terminal value multiplier of about 14. So every dollar of future cash flow is worth about $14.29 today. Simple enough?
Now watch this. We increase the WACC by just 0.5%, totally within the margin of error we've been talking about. The multiplier plummets to 13.33. That just wiped out almost 7% of the company's entire long-term value, instantly. And what if we nudge it down by that same 0.5%? The value jumps by almost 8%. The entire valuation of a company is balanced on the head of a pin. And we've already established that we can't even measure the pin with any real precision. So if the old model of trying to find one single precise number is so incredibly fragile, then what's the alternative? Well, this leads us to a whole new way of thinking, one that embraces uncertainty instead of trying to make it disappear with a formula. You see, the traditional mindset, the one that uses WACC, is all focused on quantifying risk. It's trying to predict a single future path. But the emerging mindset, which uses tools like real options analysis, is totally different. It focuses on navigating ambiguity, and it values adaptation. It accepts that the future has multiple possible paths, and there's huge value in just being able to change course when you need to. This quote from the source material just hits the nail on the head. It says the focus shifts away from a cost of capital approach toward a market-based measure of uncertainty. In other words, instead of trying to find the correct discount rate, the focus moves to valuing flexibility itself. The goal isn't to be right about the future anymore. The goal is to build a strategy that can survive and maybe even thrive when our predictions are inevitably wrong. And that leaves us with one final big thought to chew on. We've become absolutely obsessed with finding a single, precise number to justify our decisions. But maybe, just maybe, the greatest source of value isn't found in a static, precise answer, but in having the strategic flexibility to react, to adapt, and to ask entirely new questions as the future unfolds.